Happy Wednesday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, we begin as we usually do in North America. The US labor market showed unexpected resilience in April, with job openings rising and hiring hitting its highest level in nearly a year, even as broader economic challenges cloud the outlook. According to the latest Job Openings and Labor Turnover Survey, JILTS, from the Bureau of Labor Statistics, published yesterday, Tuesday, available positions climbed to 7.39 million in April, up from 7.2 million the previous month, and surpassing economists' expectations of 7.1 million. The increase was driven by private sector gains, particularly in professional and business services, healthcare, and social assistance. However, job postings declined in manufacturing, leisure, and hospitality, and local and state education, with federal government vacancies offering a rare bright spot. Hiring rose to its highest level since mid-2023, yet signs of labor market cooling emerged beneath the surface. The number of layoffs ticked higher, to the most since October, and the quits rate, a key indicator of worker confidence, dipped, suggesting workers are less confident about finding better opportunities. Quote, "The report shows a job market that's still healthy but beginning to loosen," end quote, said economist Stuart Paul, adding, quote, "Vacancies fall in discretionary service sectors like travel and in manufacturing. There are signs of slack building," end quote. Still, the ratio of job openings to unemployed workers held steady at 1, matching pre-pandemic norms, but down significantly from the pandemic-era highs of 2 to 1. This normalization supports the Federal Reserve's decision to keep interest rates unchanged for now, as policymakers await clearer signs of labor market deterioration before acting. Yet headwinds are gathering, not just in North America, but around the world. The Organization of Economic Cooperation and Development, OECD, warned this week that US President Donald Trump's global trade reset is dragging on global growth, risking to drag down the entire global system's growth rate. In its last forecast, the OECD slashed its US growth projection for 2025 to 1.6%, down sharply from 2.8% in 2024. It attributed the decline to the mounting impact of tariffs, reduced immigration, policy uncertainty, and weaker global demand. Quote, "Almost no country is spared from the slowdown," end quote, said the OECD chief economist, adding, quote, "Lower growth and less trade will hit incomes and slow job growth," end quote. The OECD also flagged rising inflationary pressures caused by trade barriers, limiting the room for central banks to lower rates. For the US, it sees inflation remaining elevated in 2026, delaying any potential Fed rate cuts. Meanwhile, domestic political tensions are adding to the economic uncertainty. Tesla CEO Elon Musk launched a blistering attack on Washington's tax and spending bill, calling it a, quote, "disgusting abomination," end quote, and a, quote, "pork-filled disaster." End quote. Musk said that he could no longer support a plan that slashes social programs while ballooning the national debt. US President Trump has made the bill, which includes deep tax cuts and a $5 trillion debt ceiling increase, a centerpiece of his second-term economic agenda. He has demanded Senate Republicans fall in line by the 4th of July, but internal dissent is growing. Fiscal conservatives like Rand Paul and Mike Lee have joined Musk in criticizing the bill's cost and priorities. The White House press secretary responded coolly, saying Musk's opposition was, quote, "nothing new," end quote, and insisting the president still supports the bill. But with Republicans holding just a narrow Senate majority, Musk's outburst could embolden wavering lawmakers. Despite these growing risks, recent data shows the US labor market remains a pillar of strength, though perhaps not for long. We will have to see. With international tensions rising, domestic discord mounting, and growth projections falling, economists caution that the current stability may prove fleeting without meaningful policy adjustments at home and abroad. And now going abroad, we move across the Atlantic to Europe. NATO is urging its European members to expand ground-based air defense capabilities by 5 times current levels, in a bid to plug one of the alliance's most critical vulnerabilities as tensions with Russia continue to mount. The ramp-up will be a key topic at Thursday's defense ministers' meeting in Brussels. The fivefold increase would apply collectively across NATO's European members, though the exact targets and time frame remain under discussion. The renewed push follows warnings from military officials that Europe's air defenses are currently insufficient to shield ground operations in the event of a large-scale attack. The initiative comes as NATO prepares for a pivotal leaders' summit in The Hague later this month. It also aligns with a broader rearmament push that includes a major build-up of weapon stockpiles and a more ambitious defense spending agenda. NATO's Secretary General underscored the urgency on Monday, expressing, quote, "We are not at war, but we are not at peace either. We must pivot toward full war-fighting readiness." End quote. The alliance's vulnerabilities have grown more apparent since Russia's 2022 invasion of Ukraine. European nations, which have long underinvested in air defense, sent much of their available stock to Kiev in recent years. At the same time, advances in drone and missile technology have rendered existing defenses outdated or insufficient. Germany is emerging as a central player in the rearmament effort. Chancellor Friedrich Merz is reportedly accelerating plans to invest billions more in air defenses, including a major expansion of the European Sky Shield initiative, launched under his predecessor Olaf Scholz. The project, supported by NATO, aims to create a continent-wide missile shield. NATO members are also moving closer to a new defense spending target of 5% of GDP, including 3.5% on core military expenditures and 1.5% on related areas such as cyber defense and infrastructure, a significant increase driven by pressure from US President Donald Trump. As NATO shifts its focus back to European defense after decades of out-of-area operations, bolstering air defense capabilities is fast becoming a top strategic priority. A NATO official confirmed that integrated air and missile defense remains among the alliance's, quote, top priorities, end quote. Now the question is, will this hole be filled before those capabilities are tested? Of course, this is all part of a new era of more uncertainty and danger on the global stage, which we have entered. If you want to be on top of the most up-to-date analysis on the biggest stories around the world through sober and grounded analysis and a balanced digest across the three most important regions of our world, make sure you're subscribed to Market Update, hit the bell notification icon, and you will be. And if you're getting some value from today's episode, don't forget to the like button. And last up, we move to Asia. Lee Jae-myung of the Democratic Party has won South Korea's presidency in a decisive victory, capping months of political upheaval and offering a potential path towards stability for Asia's fourth largest economy. Lee secured 49.4% of the vote, defeating conservative rival Kim Moon-so, who conceded early Wednesday morning. The victory follows a period of political crisis that reached a fever pitch in the impeachment and removal of former President Yoon Suk-yeol, who attempted to impose martial law last December. In his victory speech outside the National Assembly, Lee pledged to defend democracy and prevent future abuses of power. Quote, "The military must never again be used to threaten our democracy," end quote, he declared. With his Democratic Party already holding a majority in the legislature, Lee is expected to implement swift policy changes, especially in the face of mounting economic challenges. South Korea's economy is grappling with slowing growth, shaken investor confidence, and falling exports, exacerbated by US President Donald Trump's new tariff threats and demands for higher defense contributions from Seoul. Lee has promised to revive high-level talks with Washington as Trump threatens reciprocal 25% tariffs on South Korean goods despite a long-standing free trade agreement. The recent increase in steel and aluminium is going to bite the country too. Exports to the US fell over 8% in May, underscoring the urgency of those negotiations. Analysts call the US dialogue Lee's, quote, biggest short-term challenge, end quote. Markets reacted positively to Lee's win. The benchmark Kospi index rose 1.4% at Wednesday's open, reaching a 10-month high, while the Korean won gained 0.3% against the dollar. Now, it is not clear whether the market is reacting so much to Lee's policy agenda or whether it's a positive reaction to the fact that a successful election was complete, reducing political uncertainty. Though investors are likely hopeful that the new administration will expand fiscal stimulus and adopt shareholder-friendly policies. Lee's economic platform includes boosting public investment and transforming South Korea's industrial base to meet global supply chain shifts. A former factory worker and lawyer, Lee has positioned himself as a centrist in this race, appealing to moderates disillusioned by the previous government's instability. Meanwhile, the Bank of Korea has resumed its easing cycle, cutting the base rate to 2.5% in May and signaling more to come. Inflation in May cooled to 1.9%, below the central bank's 2% target, offering room for stimulus. First quarter GDP contracted by 0.2%, and annual growth is now forecast at just 0.8%, down from 1.5% in February. Lee will be inaugurated immediately, without the usual transition period due to the shortened term following Yoon's removal. As he takes office, he inherits not just a divided nation, but an economy in urgent need of repair. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Wednesday, and I will see you all tomorrow.